Hey traders, Jeff coming to you here on January 3rd, 23rd, 2025. Today I'm going to share with you what exactly happened the last 15 minutes of the day here, what potentially caused this creation of this just an amazing gamma run in the option prices at the last probably 12 to 15 minutes of the day. A lot of people trying to protect that top or short that top a little bit, or trying to find that top here. We're definitely on the wrong side of the market today. Today it's just been an unusual type of events that's driving this market to a high that certainly is far more than expected. A lot of pent-up demand in the markets in here. I'm going to kind of cover that why. Then I'm going to show you a little bit about the markets in general. Look at four major markets in here, what they're doing and what we can do to help protect yourself. So stay with me. We'll get started. All right. So a couple things happening. We had a significant surge here in the market in the last 15 minutes, and a lot of traders reached out and said, "Hey Jeff, why do you think that was the case?" Well, there are a number of reasons here, but the main thing was just a continuation of investor optimism. There was a heightened enthusiasm about the aerospace and GE and Union Pacific. They had earnings today. We're just kind of on the fringe of getting into those earnings. So these are some of the ones leading the way. And a lot of times, as some of the big names go, at least a couple sprinkled in at the beginning, so will the rest. And so that's what's one of the things that kind of filtered in towards the end. Strong corporate earnings like GE Aerospace, as I mentioned, investor optimism, and finally the presidential announcements, President Trump's statements at the World Economic Forum advocating for lower oil prices and interest rates. Well, that's not something that we felt that he would be against, but just the fact that words come out of his mouth positively influenced the market sentiment, leading to a surge in buying activity towards the market's close. A usual set of circumstances, the way it actually transpired today, but nonetheless, it came in and it came in with a vengeance. So do I think the top is here? I don't know. Let's take a minute here and look at the markets. We'll get a better view of that. All right. So we're looking at the S&P 500 or the SPY, just to kind of keep it simple in here. These are some of the lines I've been watching and drawing here. You can see how we've had that uptrend going into the beginning of the year. What happened here towards the middle of last month here with this big move down, it created this wide and whippy move. Now, typically when you see a huge market run up and you start to see really wide and whippy moves, the first thing that comes to my attention is that we are beginning to change stages. The market operates in a four-stage method, and we've been clearly in a stage two, potentially stage three. So when you go from a stage two to a stage three, you typically see wide and whippy. And then what comes after stage four? Always a stage three. It's always a stage four. Now, could there be times when we've had these stages and then we move higher? Yes, you're experiencing it right now. So let's drill down and take a look. You can see once we broke the trend line, we came back immediately, got kind of rallied back about 90%. And here, then we came back down, tested the bottom. So at that point in time, that was significant enough to draw the trend line from a supply area that we were in some sort of a wide and whippy downtrend. Market came down here. Notice the low here, it took out the lows here, right? And then bounced back here about 30%. And then it had the bearish gap that bullied here, 10-10 bar, meaning that no more than 10% of the wick is showing on either side. From that point, the market got cherried. That was here only last Monday, the 13th, right? So we're getting back in the last 10 days here. The market has been on a scream. Look at the S&P. Today, it was up prior to that at these highs at 607.82. The high of the S&P has been 609. We surged in the last 10 to 12 minutes, maybe 15 minutes, right to close within 3 or 4 cents from the high and took out the highs in here. Now, this is an extended move. Typically, what I find is it's very difficult to see hard, long, bullish moves turn. It's the most difficult. Usually when you think that you're right, you're not. We try that as traders trying to get in. From an intraday perspective, maybe you can take shots at that. But from a traders, from the room that we operate here at Full Throttle Traders, we lay back on these. Like, we don't go long in these positions, even though the market has substantially went up here. Even Meta went up to 636 today at the end of the day in the last 15 minutes. We don't try to catch this top, because when you do, you're going to be probably wrong. This is where the greed comes in. At some point, this market is going to get beyond its sustainability of getting up to this level. and it's going to turn. Is it going to be swiping lower? Probably not. Could earnings affect that? It could. All we want to do is watch the price action and realize that the S&P is on fire. We don't want to mess with that, trying to short that outside of an intraday scalp or going long into this move. It's a little bit of SOH right now. Let's take a look at the tech market. Tech market was definitely off today early on. You can see right here, we gapped down today. Now notice here, that same trend line here has been breached, and then once it got breached, it was back here. You're seeing the 21 EMAs, the SMA 8 and the 8 crossed into 21 and crossed into 50. But more importantly, it's about this bar. The tech is strong, but it's weaker than the broader market, because I think that overall we're just seeing a lot more earnings in general, not specifically tech. Now, that being said, SMCI is set to report next week, and NVIDIA is later in February. But we did gap down this morning here, and although it took a slight move lower, the tech market also rallied. But if you look going back to the S&P 500 or the SPY, look back at these, right? You see a clear difference. This is major, major momentum. A lot of pent-up demand, a lot of hype, a lot of words, the new administration coming in. This is that kind of flourish in that. Things won't stay this way. I'm not saying that they won't go higher. They certainly can and probably will, but it'll sustain itself and rebalance itself before it actually makes those turns. We drew these lines up here before because this is actually a bearish set here. We're seeing a contraction in the trend line. We did have our bearish turn at that point, and we only kind of was only up above these bars 2 or 3 before it did. Now it certainly has turned right back. Let's also take a look at the diamonds in here. They've been up 400 points a day. We had I think it was like 13 days in a row that we had red bars, or at least lower highs in the diamonds in here. Now, collectively, you can see what's happened here from 418 back to 445. Strong move back up to, it's not that far from the high. $5 away from the diamond, we're at the high. And so it's definitely making a strong move here. I think it has eyes on the 450 level. We'll have to see if that actually proves out, but we're getting close to those all-time highs. And finally, IWM. You can see this typically is a weaker market. This is the Russell 2000. You can see it double topped in here, or V-topped, and came back down. And you can see, although it rallied starting on the 13th, you can see far more subdued below the moving averages, not consistent. It did gap down and bullied today, but you can see comparative to the S&P being up here and the tech being here, the Russells are definitely way down here. Huge supply bar coming up at 232. Just be mindful of that. So these are just some of the things that we're watching in here and how they're actually breaking these lows. In the NASDAQ, you can see we came down, we broke this low, but we rallied right back up and stayed inside that region. It certainly found a home. And it went all the way back up to the tune of around $6 to about $20, $25 in the NASDAQ. Back down to only take out the lows once again. Same thing, bearish gap bullied, and then we were right back up in the saddle again. So this is far more significant in the way that it kind of pushed down here in the tech, because the tech has definitely been overbought than we were in the SPY. The SPY didn't do it quite as much. It was there, that third touch right there, then quickly gap down that just did nothing but pull all day long. So didn't take much for the SPY to get going. Took a little bit longer for the Qs, the diamonds, and the IWM was a close third. So hopefully that helps you kind of see a bridge of the markets, but we always want to be kind of concerned about where these bottoms are. If I drew a line on these, and this is the SPY, you can see, right, they're definitely wide range bars that ignite like this, leave demand behind. So if we approach demand area, although it took it out at 580.91, it wasn't but by a fringe. 580.50, so 40 cents, 41 cents from here to here, and then maybe another $1.50 or $2 to here, but it quickly refound the traction. You can see that in here, and again, going back to the Qs, there's that low on the bodies. You can see we came down significantly more several times before we began to bounce in here, and of course the IWM. Obviously, we can see these things down here. I don't even remember the turn on these things to here. But again, even though it went down much like the SPY to the 200 moving average, it certainly has a much more difficult time gaining that posture back up. So anyway, that's where we are, Full Throttle Traders. Hope this helps. See you in the room.